watching Market Wrap, a weekly update on equity markets and outlook for next week with Mr. Pankaj Pandey, Head Research, ICICIdirect. Very good afternoon, Pankaj, and welcome to the show.
Yeah, hi, good afternoon, Geetu.
Pankaj, if we talk about the market this week, I mean, this was the first week of 2023, and it was highly disappointing to see markets, gradually moving lower. Financial IT shares dragged the markets this week with Sensex ending below 60,000 and Nifty near 17,850. So what next? Do you see some more bit of correction coming in for the markets because global cues are still negative?
You're right, Gitu. So when you sort of look at the global cues have been quite lackluster, and whatever outperformance we have seen from Nifty last week, I think that is what we have sort of given this particular week. Our sense is that the overall market consolidation would extend even next week also broadly in the range of 17,800 to 18,300. I think directional move will only come when the Nifty breaches or crosses 18,300 kind of a levels. But as such, we still don't see too much of a damage to the overall structure of the market because volatility is still lower. Whatever retracement or correction we are seeing is part of the overall rally what we have seen in the month of October, November. So that way, I think nothing major negative is sort of coming out. It is just that the Fed is still sort of sounding quite hawkish in their latest comments also. So I think 2023, there was an expectation that towards the end of the year, probably there could be some rate cuts. I think Fed overall has largely sort of denied that. While the pace of rate hikes might be sort of lower, but I think the expectation that one could see a bit of a cut in rate, I think that has sort of acted as a spoiler. And which is why we have seen Nifty sort of correcting more than 1%, whereas I think mid-cap, small caps still continue to do relatively better. So mid-cap index below 1%, and same is the case with small caps. I think we've seen some bit of a profit taking happening in banking, and IT continues to remain nervous ahead of the TCS results early next week.
You rightly pointed out that mid caps and small caps really outperformed the benchmarks this time. So what is this a solace? Because we are not seeing a broad-based selling in the market. It has been a little gradual.
Correct. So there has been FI selling, especially in concentrated large caps, especially banking names, because we've seen decent amount of a rally in the banking as overall space. So probably that is sort of attributed to the correction what we are seeing in the markets. But there is no broad-based sell-off, which is why we have not turned very cautious or very bearish on the markets. Because our sense is that the domestic macros are still sort of holding up very well. In fact, the crude oil prices decline is another positive, but I think in US, the job data is still sort of continuing to remain strong. And as a result of that, Fed is left with little option but to remain hawkish.
You just pointed about all the crude prices. Crude prices are down. Gas prices are down in Europe because of a not so severe winter this time. So how do you think this is going to augur positive for the economy like ours, which is more dependent on the crude imports?
So with crude sort of declining, say 9% in last couple of days from 86 to say $78, and the gas also sort of declining significantly. I think one definitely the macro positive in terms of lesser pressure on currency and also on the inflation perspective. Now, when you come to the sector, the entire oil and gas, this is definitely positive for the downstream companies because when you sort of look at what we have also seen is that the China has increased the export quota for their refiners, which means that the domestic demand there is softer. And as a result of that, crude oil prices have declined while the GRMs have also sort of come down. But our sense is that this is favorable for oil marketing companies because the losses on diesel will sort of narrow down and profits on the petrol will improve. So the marketing performance is going to improve. And same is the case with even natural gas companies because we've seen natural gas prices sort of declining, say 11% US and about 22% in Europe. And as a result of that, our sense is that whether it is a trader like Petronet or GAIL or even the downstream city gas distribution companies. I mean, be it IGL,
Mhm.
MGL, and even
Mhm.
for Gujarat Gas. I think it's a positive move overall with gas prices sort of cooling off. So that
Mhm.
way, I think it is positive for the entire oil and gas space.
Mhm. Pankaj, one of the reports that was doing rounds during this week was that the government, the petroleum ministry, has asked for 55 to 60,000 crores from the central government to fund the under the fund the IOC, HPCL, and the BPCL for the under recoveries that they have been facing. If that comes true, would it be right to really enter these stocks at the current levels?
So I think whatever recoveries have been sought by the oil ministry from finance ministry is largely up till now the challenge is what they face in terms of in diesel they were making losses of about 5 to 6 rupees if I recollect it right. So
Mhm.
and diesel being the biggest sort of slate within for all downstream companies. And
Mhm.
we all know that the petrol and diesel prices have really not been increased, or there's no change in the retail prices. So as a result of that, the companies were incurring losses, and which is why the last quarter also was soft for these companies. And if oil ministry, so if finance ministry agrees to some of their demands, then obviously there'll be some or there'll be lesser under recovery, while things will remain incremental or will is are turning sort of incrementally positive. So
Mhm.
yes, you can have a trading strategy or trading bonds in some of these names. Uh,
Mhm.
from a portfolio perspective, yes, these are still sort of not the calls I would sort of suggest.
Mhm. Let's talk about the auto volume numbers for the month of December. They have been mixed. So, what do you make out of the numbers this time? And the tire sector has seen a bit of traction this week.
Yes, so when you sort of look at overall auto numbers, the numbers were mixed and largely sort of unexpected lines. We have seen double-digit decline in say PV and three-wheeler segment, whereas single-digit decline for two-wheeler segment.
Mhm.
CV was one space where we have seen a double-digit growth month on month. So that's a sort of a positive surprise, and also the tractor as a space is sort of doing very well.
Mhm.
And so from that perspective, I think largely numbers for companies have are were expected to be on the softer lines, given the fact that you would want to sort of produce lesser in 2022. So
Right.
that way, no material sort of impact from that perspective. But on the positive side, CV volumes growing double digit plus tractor definitely was a pleasant surprise. So that way, I think numbers were good. So nothing much to sort of complain
Mhm.
or change of view from that perspective.
Mhm. Do you like the tire space, Pankaj? Because that was something that saw a bit of good buying interest this week.
So when you sort of see crude oil prices sort of declining, obviously tire companies are also a beneficiary of that. We have seen tire companies
Mhm.
reporting one of their worst quarters last quarter, and with the kind of decline what we are seeing in crude oil prices, definitely it's a positive news for overall. And on
Mhm.
top of it, when you see the CV as a segment sort of doing well, so I think you have number of factors sort of turning positive for tire companies, and which is
Mhm.
why I've seen tire companies especially sort of doing exceptionally well in this particular week. And
Mhm.
our sense is that even from the result perspective, we would see a good margin recovery in the tire as a overall space.
Mhm. Mhm. One of the major triggers for the market would be earnings that begin from kickstart from next week. So, what is your view on the banking space this time? Because this as a sector has been outperforming, and it is expected that the numbers would be better. What is your view?
So banking, we are yet to sort of do some numbers, but a lot of these banks have come out with their business updates. So
Hmm.
when you sort of look at whether it is Federal Bank, which is disclosed 19% kind of advances growth, something like CSB has disclosed 25% growth. Now bigger
Hmm.
banks like HDFC 19% or 19.5% growth. Same is the case with IndusInd Bank. Even
Hmm.
Bajaj Finance did about 27% kind of a year growth. So overall industry
Hmm.
growth rate has been 18 odd percent. So advances growth has been pretty robust, and our sense is that overall, banking as a sector is one sector where we see little case of disappointment from the earnings perspective.
Okay, and if we talk about Bajaj Finance, despite of the good reporting of the numbers, the stock was hammered. What has been the reason behind that?
So Bajaj Finance is sort of considered as a good proxy play for overall consumption, especially consumer durables. Now, the challenge is that while the company has disclosed 27% AUM growth, but
Mm-hmm.
quarter-on-quarter growth is a bit soft. In fact, there is a sort of a degrowth. So,
Mm-hmm.
which is why I think the markets haven't sort of really liked that. And despite the fact that management has guided for 25% kind of a growth over the next 3 to 5 years, we've
Mm-hmm.
seen a good amount of crack in Bajaj Finance. Probably our sense is that a lot of these consumer durable companies are also facing supply related issues plus softer demand issues, and that is the reason largely attributed to it. But
Mm-hmm.
this quarter-on-quarter decline is something which the markets have not taken well for Bajaj Finance, and which is why we've seen this steep correction this particular week.
Mm-hmm. Now we have TCS earnings on coming next week. So, what is your expectation for the IT sector as a whole and TCS?
So IT sector overall revenue growth is expected to sort of moderate, whereas on the margin side, there is an expectation that, or we are expecting that the margins could improve from 10 to 70 odd bips. Now,
Mm-hmm.
overall for IT sector, we are expecting about say 0.5% to 3.5% kind of a growth in terms of constant currency, which is
Mm-hmm.
sale tech expected to come up with the highest or the best set of numbers at 2.5%. And whereas
Mm-hmm.
TCS, Infosys, and Wipro will deliver say 1.5 to 1% kind of a constant currency growth. LTI Mindtree numbers can't be compared because this is the first time you're going to get the entire merged entity numbers. But
Right.
besides that, I think something like Coforge and Tech Mahindra, Coforge is expected to sort of deliver 3.5% kind of a growth. Cross
Mm-hmm.
currency headwinds are not there, so that will not have much of an impact. Since the attrition is sort of coming down and subcontracting cost is also sort of coming down, so you'll see 10 to 70 odd bips improvement in the margins.
Okay.
Specifically coming to TCS, our sense is that this company will deliver 1.5% kind of a constant currency growth,
Okay.
and overall margin would improve from 24 to 24.2%. So revenues are expected at 55,000 odd crores. Sorry,
Mm-hmm.
57,000 odd crores, 15,049 crores kind of EBITDA, and about 10,700 crore kind of a profitability. So overall, our sense is that TCS will come with decent set of numbers. I think H1 has been pretty strong. So compared to that, this will look a weaker quarter because we have a larger number of holidays in this particular quarter.
Okay.
So marginal improvement is what we would expect from the overall metrics. I think the commentary would be important in terms of certain verticals, say BFSI or manufacturing. How
Mm-hmm.
are they seeing order inflows there? So I think that is
Mm-hmm.
one of the other things to watch out for.
So if somebody wants to build positions in IT space, he should wait for the quarter three numbers and listen to the commentary first, and then really take a call on where to invest and which stock to buy.
So I think for IT to sort of do well, you need two, three things to sort of happen. One, I think the Fed needs to sort of tone down their hawkish view. So I think that is yet not happening.
Mm-hmm.
Now on the company specific, because if Fed is not sort of toning down, then it means that there will always be pressure in terms of how the tech spend will sort of pan out. So
Mm-hmm.
so 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 that is a macro variable which needs to be sorted out. Then I
True.
think when you look at company specific, while we will see margin improvement, but I think the bigger commentary is going to come in from Q4, which is when the companies will tell what is the kind of pricing growth they can expect, or what is the kind of overall inflows they are expecting,
Mm-hmm.
and also a bit of a perspective on attrition and other subcontracting costs. So Q4
Okay.
will give a probably March onwards, you will get a larger or a better picture for IT. So which is why price performance is still some time away from for most of the IT companies. And
Okay.
major incremental positive in this particular quarter, that is when we would expect some bit of outperformance. As of now, it does not look like you will get a major incremental positive.
Pankaj, commodity prices world over have been coming down. We have steel, aluminum, rubber prices coming down by 20 to 30%. So, what is the kind of impact that you see on auto companies of these raw material, price coming down? How do you expect them to impact their margins this time?
So for auto companies, when you sort of look at YOY, there is hardly any volume growth. Quarter on quarter, in fact, there is a bit of a degrowth. So what is looking a lot more brighter, as you rightly pointed out, is that the key raw material like say steel, aluminum, or rubber, they are down about 15 to 20% odd. Something like plastic is down 50%. So our sense is that overall you will see a good gross margin expansion happening in the sector, and including tire companies. So gross margin expansion is expected about 150 bips. And overall, we would see even the profit or the EBITDA margins also sort of expanding. And tire companies will see a slightly better expansion because rubber prices of late has corrected even more. And also, overall, our sense is that CV is sort of doing well, so which is why Apollo Tires is expected to witness a gross margin expansion of 250 bips. And I think revenue growth could be about 4% quarter on quarter, and EBITDA growth could be 6%. Profit growth may not be there because last year you had higher other income, so that may, and this is all excluding Tata Motors because Tata Motors is something very difficult to sort of figure out given the global factors in play for Tata Motors.
Whenever the markets are volatile, we look at defensive. So one of the most defensive space that market participants bet on is FMCG space, and FMCG space has been holding up quite well. Now with the input cost coming down, what is your view on FMCG space as a whole, and what is the kind of earnings that you expect from big companies like HUL, ITC?
So even this sector or these bigger companies also had witnessed margin pressure, and as a result of that, this volume growth and pricing growth template had sort of gone skewed. Now, for a big company like HUL, we are expecting about 12% kind of a revenue growth, 5% from volumes, and 7% from pricing growth. While most of their segments are expected to do well, home care 23% because they've taken aggressive price hike in detergents. Beauty and personal care also expected to do well, but tea segment is stagnant. And then, overall, there could be a gross margin contraction on a YOY basis. But things have started to improve quarter on quarter basis, and which is where the positivity lies. So we are expecting about 250 odd bips kind of a margin improvement quarter on quarter. And overall, that is where I think things are turning positive. And same is the case with ITC also. ITC could deliver about 6% kind of a growth, while cigarette business is going to deliver, say, 10% kind of a growth, largely on the back of 7%. There are other businesses are also sort of doing well, be it hospitality, be it paper. But since the government has banned wheat exports, agri as a segment will witness a decline. But overall, we are expecting about single-digit kind of a growth, and margins again for this company is expected to sort of expand. So because this company also had been sort of impacted because of margins, so we are expecting about 300 plus bips kind of expansion in margins. So that way, I think the margin expansion in autos and FMCG is what will be the key or is going to take center stage.
Pankaj, you keep on doing channel checks also. So what is the kind of feedback that you're getting on the rural demand side as far as the FMCG space is concerned?
So I think one of the things which are sort of turning out positive is that rural as a segment has been something which has been sort of laggard for most of the FMCG companies. But now, what do you see, say, for example, take the case example of wheat. Wheat has been very remunerative for farmers because MSP, or when you look at prices from 21 rupees, now the prices are ruling to 28, 29 rupees a kg. So we've seen a sharp improvement, and our sense is that rural as a segment is sort of started to pick pace. And which is why I think earlier the only urban as a segment was doing well, but now our sense is that the rural as a segment is also sort of picking up, not only for
Mm-hmm.
FMCG products but also for other products. And with
Mm-hmm.
marriage season round the corner, I think overall our sense is that even the demand for apparels is on the rural side is better. So our sense is that things are turning better, especially on the rural side, and even autos. When you sort of look at, I think they are also sort of pointing towards a better rural recovery, especially from a demand perspective.
Mm-hmm. Let's now talk about the hidden gem. So, which is the stock that you will be discussing today?
So the stock I'm highlighting is a bit of a metal player, but does quite a bit of specialization, and so it's a indirect play on defense plus aerospace as well. So the company's name is Midhani or Mishra Dhatu Nigam Limited. It's a
Mm-hmm.
PSU which has got a market cap of over 4,100 odd crores. Here our target price is 285.
Mm-hmm.
So offering 30% kind of an upside.
Mm-hmm.
Now, this company is a specialty player, so they supply a wide range of super alloys, titanium alloys, specialty steel, and this is used in defense. Defense and aerospace. So, of their entire order book of say 1,500 crores, 55% is from defense, 35% is from aerospace, and the balance 10% from other segments. And now this company has done a capacity expansion or put up a capex of 500 crores. And
Mm-hmm.
overall, our sense is that that is going to sort of help them increase their turnover by 500 odd crores.
Okay.
Overall, company has guided for about 1,000 crore kind of a turnover this year. And this capex plan, where they are sort of putting a wide plate mill, will find application in niche areas of defense and aerospace. So
Okay.
our sense is that this company is placed well for the kind of opportunities which are shaping up in both aerospace as well as in defense.
Mm-hmm.
And overall, our sense is that this company will revenues will grow at 19% to about say 1,200 odd crores in FY24, and margins are good also at about 29.5%.
Mm-hmm.
Profit is expected to grow at 17%, and this is trading at a decent valuation of about 18 times. So I think this is one company which has really not sort of captured much of our limelight, but our sense is
Okay.
that overall, with the kind of application for its product, this company will get attention going forward, given the good set of numbers anticipated.
Mm-hmm. So, Pankaj, next week, how would you strategize the market? Because we have earnings, we have data coming from US, we have uncertainty still ruling firm in developed nations. What is your broad range for the markets next week?
So our sense is that Nifty is going to extend the consolidation. So broader range would be 17,800 to 18,300. And if we break out, say, 18,300, that is when the market will turn directionally positive. Otherwise, largely you'll see more of a stock specific action, given the fact that we are seeing an onset of IT company result season. Overall, in a result season, you see more of stock specific action, and that is what we would
Right.
broadly expect.
Thank you so much, Pankaj, for your time and your views on the market.
Thank you so much.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.